What's up, guys? I'm Mike from StockedUp. In this video, we're going to be talking about if the options market is mispriced. So I'm sure if you trade options, I'm sure you know that when the market falls or even if it rises, volatility is an options trader's dream. So we just want the market to move, and especially we want the market to move when no one is expecting it. So it's one thing if a stock goes crazy and their implied volatility is sky high. So for example, right now on SPCE, Virgin Galactic, the implied volatility is higher than it has ever been. It's at 169%. Everyone knows SPCE is going to be very volatile. But stocks like Procter & Gamble, PG, their implied volatility is pretty low right now. It's very close to 6-month lows, and we're still seeing candles where it's like as if there's as if there's a chance that PG can have a pretty nice fall. So what I mean by that is you see a decently sized red candle on PG today, right? Down 1%, closing near its lows. When else have we seen this? We've seen this right here. We've seen it right there, right here, right here even, right here. Recently on February 7th, it was at $126, and 4 days later, it's at $122.85. So here's the thing. Right now, I got a little bit excited in the middle of the day today with the market because it was down a decent amount today. Nothing crazy, nothing significant. But right now, it's down about 170 points. The market was down, what was it, 29,116. It was down about 250 points, you could say. No, about 200 points at its lowest. But anyways, with options, right? It's one thing if everyone's expecting a move. So for example, SPCE. Everyone's expecting SPCE to be very volatile, just like how Tesla was going crazy a couple weeks ago, how it almost hit $1,000. Everyone knows these stocks can be volatile because their implied volatility is so high. When implied volatility is high, it's hard for options traders to make money when they long calls or puts. It's easy to sell credits rather than stuff like that when implied volatility is high. But when implied volatility is low, that means that no one is expecting a move in the stock. So if the stock does move, then that will literally create 500%, 1,000%, 300%, 1,200% moves in these options, especially weekly options. But you can even buy options like 2 months out for extremely cheap. So I'm going to show you guys an example. So there's a couple stocks I'm looking at that I see a huge mispricing in, where if the market does fall, these options will explode. Now, I'm not saying that the market is going to fall this week or next week, but all I'm saying is right now, technically the market was down about 170 points today, right? Apple cut guidance, which is not good for the market. There's other companies that are pricing in the coronavirus and the impacts that is going to have on their quarter 2 earnings. But all I'm saying is that if the market does fall, these stocks put options are going to explode because no one is expecting a move from them. The first one, Procter & Gamble. So Procter & Gamble is a great play. You could get, you could get the obviously you can get weekly options for extremely cheap. You could pick up one strike out of the money right now for $40. But even if you go out to let's say April, right? If you go within the first standard deviation, it'll only cost you about $120, and you have almost 60 days. Even the March contracts are super cheap. They're just amazing plays. If the market falls, these plays are going to explode. I'm not saying the market's going to fall, but if it does, these ones are going to explode because no one is expecting that, and we know that because implied volatility is so low. Next one, Pepsi. Pepsi, it had a huge run up, and the implied volatility is very low. They just had an earnings crush, and they didn't really go up too much on earnings. So if the market does fall, just like the weekly options, those will obviously explode the most if Pepsi falls this week. But if it just gradually falls, the monthly options are also a good deal. What else? Procter & Gamble and PG are both down about 1% today, so those are good plays. But that's generally how it goes. Like you can see, like some stocks like Home Depot right now, it's a similar setup to Pepsi. However, the implied volatility is at about 6-month highs, so it wouldn't be worth buying the put options at that point because people are expecting more of a move from Home Depot because the implied volatility is so high, whereas with Procter & Gamble and Pepsi, no one is expecting a move because the implied volatility is low. So I hope that makes sense. Keep in mind, guys, like if you did want to play these, the plays are going to move fast, especially like the weekly options, but you don't have to feel the need to enter like a lot of money now, or even like enter quickly. You don't have to be first with these options, guys. And also, even if you do want to enter these, you don't have to enter all your intended position at once. Like let's say, for example, you want to put $3,000 in Pepsi. You don't have to put all $3,000 in tomorrow. You could put in like 1,000 or 800, and then if the play starts working for you, add another 1,200 or 800 or whatever the case may be. You could scale in and out. You don't have to go all in, all out, at once. Feel free to scale in. It'd be safer. You might end up paying a little bit more, but that's okay. It's better to be late than wrong. You guys really don't have to be the first ones, especially with options. Remember, these things decay, and if you guys want to, you can also sell you can make them like debit spreads to limit your risk. So keep that in mind, guys. If you guys have any questions on any of the stocks or anything, let me know in the comments down below. But other than that, thanks for watching.